This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
July was a tale of two markets, AI and everything else. The tech sector lost money, in some cases big money, while the rest of the market remained in the black. For the sexiest names, was this just a flesh wound, as the famous Monty Python line goes, or the beginnings of something uglier? Up next, let's think about what's at stake, as well as the health of the overall market. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. The S&P this week crossed the 7,700 threshold for the first time. Think about that in perspective, right? Just 5 years ago, it was at 4,400. A decade ago, 2,200. It is amazing how far we've come in a relatively short period of time. But I will say this was the first record high for the market since June 2nd. Last 2 months have actually been slightly negative. So if you've been at the beach, the overall market hasn't done much. In fact, it's the first back-to-back June and July decline since 2011. But that belies the fact that there has been a tremendous amount of dispersion and volatility underneath the surface. And I've talked about this a lot, and I want to continue to talk about it because I think the headlines sometimes send a different signal as to what's actually going on. The S&P and the Dow actually have not been that volatile. I mean, yes, they sold off pretty significantly when the war broke out in March, but since that time, not that much volatility. But there's been a lot, like I said, underneath the surface between sectors and certainly at the individual stock level. To wit, in July, the energy sector up 12%. Financial sector up a little over 6%, but the tech sector was down 8%. The semiconductor index specifically down almost 18%. The S&P 500 momentum basket, which again, what is momentum? It's essentially chasing stocks that are going up, right? I mean, that's really what momentum investing is. That factor down 11% for the month. So those levels of dispersion between kind of what's working and not working at the sector level or industry group level, some of the widest we've seen in a long, long time. Even at the individual stock level, we're seeing huge moves. Ben Carlson up at Ritzold Asset Management, he just noted that I guess as of a couple weeks ago, 6 of the 7 Mag 7 constituents were in a drawdown. Okay, significant double-digit drawdown from their highs. At the time he tweeted this, again, this is a couple weeks ago, this is before these companies reported earnings. Microsoft was in the midst of a 28% drawdown from its 52-week high. NVIDIA 19%, Google 16%, Amazon 17%. And then just a week ago, Microsoft, since that time, up 17%. Amazon up 18%. And some of the things that had been doing well, like Apple was down 12%. I bring this up because these are not, penny stocks, right? Usually you see 20, 30% swings in, $2 stocks with no earnings. These are multi-trillion-dollar companies moving with this degree of volatility. So not only should you know that, but you should also understand that the fundamentals, of course, of those companies, right? Earnings, sales, business prospects going forward, competitive risks, those things are not changing anywhere near as much as the stock prices, right? These are sentiment shifts. These are money flow shifts. Very important, crucially important, that you understand the stories, the narratives, the fundamentals behind the stock price movements, or you're just going to be whipsawed. It's going to be very difficult to keep up. But let me go back to kind of what transpired in the last month. I think from a positive perspective, at least in my opinion, we are seeing significant market broadening. More stocks are, quote unquote, in gear. In fact, I guess this wasn't in July. I guess it was just this week, the first week in August. But for the first time all year, all 11 sectors in the S&P 500 are in the green for the year. That's pretty momentous, right? We haven't seen that a lot. And something like, according to FactSet, almost 70% of S&P 500 constituents are above their 200-day moving average, which is a measure of kind of intermediate-term momentum. That's pretty darn good, right? We're seeing a much broader market, and in my book, a broader market is a healthier market. Remember, I've talked about this a lot over the last few years, so has Chase Hinderstein, my colleague, there have been times where essentially all the return in the S&P was coming from a handful of names, literally a handful of names, and most of them tech and AI oriented. Much different conditions today. I'll just highlight a couple things. The healthcare sector has finally started to do better. You may recall, as of a couple months ago, I was publicly saying, almost pounding the table, that we were seeing one of the biggest, maybe disconnect's the right word, or maybe just variance between the healthcare sector's not only performance, but also valuation and the rest of the S&P in something like 30 years. To the downside. Healthcare was underperforming that much and undervalued by that much. And that gap has not completely closed, certainly from a valuation perspective, but from a performance standpoint, pharmaceutical stocks, for example, are making new 2-year highs relative to the S&P 500. So we're seeing much better conditions in aggregate from healthcare and drug stocks specifically. And I think what's going on with financials is not getting as much attention as it probably should. There's an old kind of quote that I remember from Louise Yamada. She was the head of technical analysis back at the old Smith Barney, way back in the day, and I was there at the time. She always said, quote, "The bigger the collapse, the longer the time needed for repair." I say this because look at what happened with technology. After the dot-com bubble popped, it took 20 years for the technology sector to finally get above its dot-com bubble highs. 20 years. And by the time technology finally did get back to that high, which was 2019, a lot of people thought the story was already over. A lot of people who were down they got their money back and then they sold. Well, the supply was gone. In other words, the overhead selling pressure was gone. And then there was room for a brand new uptrend. And that's, of course, exactly what's happened, right? Last 6-7 years, technology has been in the pole position. Well, I'm not saying banks are going to go up as much as tech has over the last 5-6 years. In fact, I doubt they would do that. But similar conditions. For the first time in the last 2 weeks, the bank index broke above the highs right before the financial crisis. So again, very similar to the dot-com bubble. Just like tech got wiped out then, banks got wiped out in 2007, 2008. Of course, some got permanently wiped out, right? Lehman Brothers, Bear Stearns, we all remember that. But even the rest of them got wiped out. It has taken this long to get back to the highs. So when you see these multi-year, in some cases multi-year, multi-decade breakouts, they can be powerful. We're seeing it also with Japan right now, right? The Nikkei finally got back to a new high after 30 years, literally, from the 80s. So we'll see. So banks and healthcare stand out for me as two sectors to watch going forward. Going back to the volatility, I've talked a lot about what can happen when everyone is chasing momentum, everyone's buying the same names, and there's this kind of belief in the infallibility of a certain trade, right? Couple poster children for this. One is the Korean stock index, the KOSPI, K-O-S-P-I. We talked about the fact a couple weeks ago how essentially half of the index are 3-chip names. Okay, so in many ways that index is a proxy for memory chips. That's really what it is. And we talked about the fact how leverage, margin, people taking on leverage and essentially debt to buy stocks increased something like 30% from the beginning of January through a couple weeks ago. Well, the Korean stock market doubled in less than 6 months and then corrected 40% in about 4 weeks. Okay, so for most of July, the South Korean index was a disaster, as were memory chips in general. In fact, I read an article in Bloomberg saying how over 300,000 individual leveraged accounts were liquidated and over 1.2 million accounts received margin calls. This is in Korea. But of course, since then, we've actually had a bit of a bounce back, in some cases a violent bounce back. So it's been boom, bust, boom. Stocks like Western Digital, Micron Technology, some of those names rebounded 10 to 20% in a single day a couple weeks ago. So you've had significant double-digit swings, the lesson being that you have a lot of groupthink there. And I think it's a little bit too early to tell whether, the kind of the pop that we saw in July was just a short-term correction, with now, the trade resuming again, or whether it was the beginning of something more pernicious. I just don't know at this point. Another poster child was the Situational Awareness Fund. You may have read about this one in the paper. It's a hedge fund formed by a former OpenAI researcher. Back in March, had a little over $9 billion in assets, went to $20 billion plus in June, and then, according to the Wall Street Journal, peaked at $45 billion in July. Problem is, they were leveraged. They were margined to the hilt. Completely destroyed in July and ended up selling the portfolio for $10 billion. So essentially wiped out all the gain in a very short period of time. All right, I'm not going to belabor the point. I think you know what I'm saying. Leverage is not your friend over a long period of time, in my opinion. Maybe there are exceptions to this. I'm sure there are hedge funds that have used it effectively and posted big returns. But for the average investor, very difficult game to play because when the music stops, you're not necessarily getting a heads up as to when that music's stopping, right? I would also just, go a little bit further. I looked at some data from Citadel Securities, and it's amazing to see the proliferation in leveraged exchange-traded funds. These are ETFs that give you 2, 3, 4, in some cases 6 times exposure to either a particular stock or a particular sector or asset class. And of course, they're leveraged, right? Which means if things are going well, you're going to make a lot of money. If things aren't going well, it can collapse really quickly. I only bring this up because the total amount of leveraged ETFs back in 2020, according to Citadel, was about $50 billion with a B. As of the end of July, $200 billion. So fourfold increase. And 130 of that $200 billion is in semiconductor leveraged funds and other types of technology funds. So you get what I'm saying. When everybody is chasing the same trade in a leveraged way, whether it's hedge funds, the South Korean index, individual investors here in the United States, this is what can happen. Goldman Sachs has a retail basket. It's a basket of stocks that are most owned by individual investors. It was down 12% in July. The S&P was basically flat in July. So retail investors really underperformed. So I want to make a broader point. Now, the good news is you, the listener, many cases are clients, but certainly the listener more broadly, I know that you're not making, in general, a lot of these mistakes that a lot of people out there are making. Our listenership tends to be a more conservative group, in many ways a value-oriented group. But there's still some lessons that I think can be learned from all this that are worth sharing, in my opinion. This article that I just read on Ask Livermore, he's a financial blogger I've followed for a long time. He estimates by the end of July, and he got this data by looking at the most widely held stocks across retail brokerages, he estimated that the average individual investor was down 13% for the year as of the end of July. Okay, of course, the S&P is in positive territory for the year as of the end of July. So he estimates the individual investor, on average, is underperforming the S&P by over 20%. Why is this? Well, retail investors don't underperform because they lack intelligence. They underperform because they tend to buy narratives instead of cash flows, momentum instead of valuation, and excitement instead of probabilities. Okay? I think that's a pretty succinct way to put it. Whereas, market cap weighted indexes like the S&P naturally allocate more capital to businesses where market values are growing, right? That's the definition of a market cap weighted index. Individual investors are frequently concentrated in whatever is attracting the most attention. Social media favorites, Reddit discussions, influencer recommendations, the perceived quote-unquote next NVIDIA, right? That's where most people put their money. And again, let me be clear. I'm not saying that you do that as our listeners, but I think we've all had a little FOMO from time to time, right? We all see somebody making a lot of money on something, or we hear about something on CNBC, and we're wondering, why don't we own that? Why don't we have more of that, right? We all do that. The other thing is concentration. Most retail investors are not diversified, according to this piece. 5 to 10 individual stocks is the average holding. Portfolio mathematics work against you when you do that. Even if 1 or 2 holdings generate exceptional returns, a couple catastrophic losses can wipe it all out, right? And that's certainly what we saw in many ways in July. Behavioral biases kind of widen the gap. Professional investors, fund managers, hedge fund managers, they typically begin with a valuation framework and then decide whether market expectations are too optimistic or too pessimistic. That's how they, in many cases, decide when to buy or sell. Well, individual investors often reverse that. They fall in love with a story and then search for evidence to support it. Confirmation bias, right? And there are other differences, right? Timing's another headwind. Individual investors often buy after periods of strong performance because rising prices create confidence, right? Validation. Often the opposite of what professional investors do. And the one last thing I would say on this is, and I've said this for years and I'll say it again, many individual investors confuse a good business with a good investment. And that distinction has likely destroyed more wealth than any other distinction that I can think about or error that I can think about, right? The key is not just understanding whether it's a good business or not, it's understanding what the market expectations are for that. And we're seeing a lot of that right now where the fundamentals of a lot of these companies that were down 30, 40, 50% in June and July have not changed, and they're still spectacular. It's just that the market assessed a valuation to those names that might be almost impossible to deliver upon, or at the very least where the bar is so high where the execution risk is significant. All right, I'll leave it there. And again, I realize most of you listening are not susceptible to these issues, but I think there's a part of this in all of us, right? So just remember this. And again, July was a good example of how it can come home to roost. The good news is I do think some of the speculative excess has been flushed out of this AI bubble. And again, I'm not here to say that AI stocks can't go lower. Of course they can. Okay, that'd be irresponsible of me to suggest that they can. But when people talk about excess speculation, certainly some of that has been corrected over the last 30 to 60 days. It's not surprising to me that here in August so far, you've seen a rebound in some of the highest quality names. Okay. All right, let me just switch gears briefly. Certainly want to talk about earnings. I've mentioned at length over the past 2 years that a lot of the kind of media headlines are actually driving the markets. Okay. In other words, the media is focused on geopolitics and maybe politics as well, and economic headlines, right? Tariffs, the Iran war, midterm elections. And I'm not saying these things don't matter. Of course they do. But I think what's really been driving this underneath the surface is that corporate America continues to outperform expectations. And here we are about, maybe 3/4 of the way through second quarter earnings reporting season. Once again, earnings growth in aggregate is over 10 percentage points higher than what was predicted as recently as a few weeks ago. Okay? Better and more companies are beating earnings on the top line and the bottom line than what we've seen over the past few years. And what's the underlying driver? Profit margins. Profit margins this quarter, according to FactSet, almost 17%, 16.7%. By far the highest level in history. Now, skeptics are going to say that profit margins are mean reverting, right? That's kind of the whole point about capitalism, right? High profits attract competition and therefore eventually drive down profit margins. So there's certainly a lot of skepticism around the ability of companies to continue to be more profitable and to drive this type of earnings growth. We all know about economic headwinds, right? higher oil prices, now higher interest rates, the waning of tax stimulus effects on corporate spending. All those things are true. But who knows? If we're only in the first or second inning of AI adoption and AI efficiencies, I think it's difficult to say that this is all going to end tomorrow. So we'll see. I would also say that even though a lot of this margin growth has been concentrated in tech and some of the Magnificent Seven names, 6 other sectors, financials, energy, utilities, information technology, materials, and industrials, according to FactSet, are all expected to see margin growth over the rest of this year. Okay? And there are a lot of factors for this, right? Strong pricing power, operating leverage. I mentioned AI, tech-driven productivity, cost cuts. But I think the biggest thing is that people have money, and companies, despite the higher prices that we've seen, over the last 5 years, particularly coming out of COVID, we're still paying those prices. So none of us like what airline, tickets cost. None of us like the fact that an average meal, an average entree is now $40 or $50, even at mid-level restaurants. But we're still paying it. We're still paying it. So companies have not had to cut prices, and that's probably the biggest deal. So that's why I pay so much attention, not to what economists say could happen, but what is actually happening. Are people still going and spending the money? And I realize a lot of people in this country are not able to spend the money. But when you look at the aggregate data that's supported in many ways by a good stock market the last few years, suggests that the consumer has been more resilient than people thought, and therefore pricing power is more resilient than people thought. The other thing I'll just mention briefly, and then I'll move on, is almost all the gains in the market, really the last 2 years, but especially this year, have come from that earnings growth. We have not seen multiple expansion. In other words, people are not paying higher price-to-earnings ratios today than they were in January. In fact, coming into this year, the average multiple on the S&P, according to FactSet, was about 22 times earnings, for the index as a whole. It's now down, depending on how you measure it, about 19 times. This is forward earnings, 19 times, okay? And a lot of the big names are actually cheaper today than they were a year ago because their earnings have grown faster than their stock prices. So take NVIDIA, for example, and I'm not offering any sort of research opinion on NVIDIA, but just giving you the facts. This company has had one of the highest growth rates, right, of any over the last 5 years, and certainly for a company of their size, it's almost unprecedented. They're down to roughly 18 and a half times next year's earnings. So they're actually trading at a discount to the S&P 500. Look at the semiconductor index in aggregate. If it were a sector, it would be the 4th cheapest in the market, with the highest expected growth rate over the next 12 months. So, in fact, the semiconductor index is significantly cheaper than the consumer staples index, where you see average growth rates in the low to mid-single digits. So, what's going on here? Well, obviously, there's trepidation and anxiety about what the ultimate earnings path for these companies is. And I think that's fair, right? Whenever you have a new technology, we have no idea what NVIDIA is going to be earning 3, 4, 5 years from now. I think people are expecting a slowing growth rate, and probably rightly so. But I bring all this up because if AI adoption goes better than people are expecting, if we see better profit margins, if we see more widespread adoption, if we see Main Street really harness AI and capital expenditures still fairly robust, then we may look back on this and say, this was an interesting time to consider more tech exposure, not less. That's not my pitch to you. I'm just saying that's a possibility, and I think we should be open-minded to that. Let me just switch gears for a second. We heard from the new Fed chair, right, the other day, and I don't think it went particularly well, if I'm being honest. It's kind of a Wall Street truism that the market tests the Fed, a new Fed chair, early in his or her administration. And what does that mean? The bond market will send a signal that may not be what the new Fed chair wants to send. In this case, the new Fed chair was a little bit wishy-washy, if I'm being honest, right? He failed to back up his recent tough talk about price stability and was non-committal about a rate hike later in the year. And in fact, they've gone away from that whole dot plot thing. So it was really kind of vague on signaling where the Fed kind of stood at this time. Now, in his words, that's by design. He doesn't want to telegraph things in the way that Chairman Powell and others have, but it left the bond market to form its own conclusions. And the bond market has voted. If you look at longer-term bonds, the 10-year Treasury up over 4.6% from 3.9% earlier in the year. The longer-term bonds, 30-year Treasury, up over 5.2%. And even shorter-term bonds are pricing in a couple of rate hikes. So it's a good lesson that the Fed policy, quite frankly, only matters for the rates that banks lend to each other, the Federal Reserve rate. For most of us dealing with credit cards and mortgages and student loans, those rates are determined by market forces. And the market is saying either that the Fed needs to raise rates or is questioning the credibility of this new Fed administration. I'm not sure which one is right. We'll find out. But my guess is that the Fed is going to have to do something. The good news is a lot of it may already be priced in, right? The bond market is already factoring in rate hikes. Okay, so I'll leave that there. But what does this mean for you and me as investors? Well, we're in the midst of a pretty long drawdown in bonds. I mean, if you look at the Bloomberg U.S. Aggregate Bond Index, it's still down about roughly 17% by my math from August of 2020. I mean, remember, we were firmly in the COVID era. Rates were close to zero. Bond market has been negative over that period of time. That's the bad news. The good news is if you're an investor, you may have an opportunity here. And I say may because it's dependent on your particular situation, right, whether bonds are appropriate for you. But I've mentioned 1,000 times there is a very strong historical correlation between starting yields and future returns, meaning if you can get, let's say, 5% on a corporate bond portfolio, okay, there's a pretty high likelihood. It's over 90%. That's about what your returns will be over the next 5 to 10 years on an annualized basis, all right? So that's what we're talking about. I mean, high-quality corporate bonds, if you're willing to ladder them out, you're probably able to get over 5% right now. That is pretty significant. The other point I wanted to make, and I've made this point before, but I really wanted to enforce it. People misunderstand the risk when yields are already this high, okay? What do I mean by that? JP Morgan came out and looked at, what happens if the 10-year yield goes up another percent? So it goes from 4.65% roughly to 5.65%. What would that do to a bond portfolio? Well, by their math, it would be a 3% negative return. And that's with a full point increase in rates. So what am I saying? What I'm saying is with yields up around 5% versus the 0% of 5 or 6 years ago, your risks are much lower going forward because you're being compensated with much more interest, higher coupons. Where if you're locking in a 1% yield, you have no buffer. So price is much more of a drag on your future returns. So again, this is not a call to arms and saying you should go out and buy bonds, but I think when you read these headlines saying, don't buy bonds, the bond market's a disaster, that might be true, on a day-to-day basis, week-to-week basis, if you're worried about your quarterly returns or your monthly returns. But on a long-run basis, which should be the case for everyone listening, not only can you lock in high yields, but your risks are probably skewed to the upside, not the downside over time. And even if rates do go up a full point or more, well, if you have a laddered portfolio of individual bonds, what's going to happen? You're going to have bonds coming due, and you'll be able to reinvest them into higher yields. So I know I'm talking in generalities. You should really consult with your financial advisor about the specifics and how germane this is to your situation. But I do feel that if you buy high quality, and credit quality is an important consideration here, but if you're buying treasuries or very high quality corporate or municipal bonds, some of the kind of hyperbolic risks that you're hearing in the financial headlines in many cases are overstated. So think about that. All right, stick with me. We're about 3/4 of the way through second quarter earnings reporting season. I do want to highlight a few things that I'm hearing from some of the holdings that we have in our client portfolios. Back in a sec. Midterm election years are almost always the most volatile, and so far 2026 is proving no exception. Will you let the inevitable churn in your political leanings disrupt your plan and portfolio? Tune in every week as we discuss the latest financial trends and what investors need to know. To avoid the endless barrage of distractions and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James and Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As I mentioned, we're about 3/4 of the way through second quarter earnings reporting season. I want to update you on a few things that I'm seeing, hearing, reading, some of the names that we own in many of our client portfolios. Just as a reminder, the names that I mentioned, we do own for a number of clients, and I also own personally, so that is a conflict of interest. Keep that in mind. Also, these are not research recommendations or stock picks. Very important that you do your own research and or consult with your financial advisor to see if these are appropriate for your level of risk tolerance in your particular financial situation. I read something, and I apologize, I can't remember where I saw it. I think it was Bloomberg. It talked about how U.S. obesity has declined from a 2022 peak of roughly 40% to 36.4% as of a couple months ago. Meanwhile, the share of Americans currently using GLP-1 medications has jumped from 3% in 2024 to 11% in 2026. So this article was drawing a straight line from GLP adoption to lower obesity rates, which may or may not be completely true, right? There's lifestyle, there's diet, but GLP, according to this author, was the biggest contributing factor. I found that very interesting because all you read about is how fat we're all getting, right? And so the GLP space is really interesting. And there was a really good article in Barron's a week ago that I want to reference to some degree, but I also have my own thoughts about Eli Lilly, the competitive landscape as well, Novo Nordisk, but the article was mostly about Eli Lilly, which now, of course, is the most valuable, largest market cap healthcare stock on the planet. They reported their earnings this week. I'm not going to get too much into the earnings. They were fairly well received by the street. They beat on the bottom line, beat on the top line. But I don't really want to talk about that. I just want to highlight some things kind of in the big picture with respect to Eli Lilly that I think you should kind of keep in mind if you either own the name or are considering owning the name. You know, a lot of people are starting to compare the GLP market to the AI market in the sense that they're all capacity constrained with immense pricing power and vast and growing demand. Maybe a little simplistic, but I think that makes some sense. The thing about the GLP market is the total addressable market, it is yet to be determined. And it looks like it's a heck of a lot bigger than what people thought just a few years ago. Remember, it started with kind of diabetes, right? And then it's morphed into weight control, obesity management. But it looks like there's applications for all kinds of stuff. Sleep apnea, fatty liver, heart disease, kidney disease, Alzheimer's, Parkinson's, psoriasis, asthma, maybe even cancer risk reduction. I'll get to that more in a second. But the total potential market for these drugs seems to be expanding with every research and development update we get from these guys, not just Eli Lilly, but the whole space. It's really amazing. Multiple pathways that these drugs appear to be able to help. And you saw this from JP Morgan. Back in 2022, Barron's noted that, I guess it was JP Morgan thought the GLP sales would reach $34 billion by 2031. Well, they came out this year and thought it would be close to $190 billion by 2035. So JP Morgan has increased their, yes, they went out a few years further, but they've increased their sales projection 5 to 7-fold. And they may have to do it again if some of these things come to pass. And there are a couple other things kind of adding to the growth. For one, Medicare was kind of a drag on the outlook for these names, right? Because for a long time, they did not pay for drugs intended solely for weight loss. Well, that changed on July 1st. There was a temporary program that went into effect. It's going to become a permanent program. I say permanent. It's always subject to what Congress does, but expected to be replaced by a permanent program in 2027, where more than 2/3 of Medicare beneficiaries who are obese will get reimbursements for these treatments. And then beyond that, workplace coverage for obesity meds has gone from about 44% of employers in 2024 to 60% this year, expected to be 65% next year. That's from the Barron's article. So those are two pretty significant tailwinds that were really not in the models, really a year ago were not in the models. There's also a lot of experimentation about the delivery. Right now, of course, some of the most effective drugs are injection. The pill technology is really starting to gain traction, and I think Eli Lilly specifically has a pill that really has a lot of application overseas, in particular third world markets, because you don't have to store it in a fridge or anything like that. So it's much easier to ship, much easier to be used in places that don't have, widespread refrigeration. So that's an interesting technological wrinkle that I think is giving Eli Lilly an advantage going forward. The other big thing that I would just mention, of course, the enemy of all drug stocks are patent cliffs, right? You have this great drug, then it goes off patent, and then it's open to generic competition, right? Well, that doesn't look like it's going to spoil the outlook for Eli Lilly, for example. Eli Lilly's key patents do not expire until 2036. They have enough specific formulations and delivery mechanisms that a lot of people think that'll extend past 2040. Okay, so it's not like what we've seen with the cholesterol drugs and some of these other big drugs. Of course, AbbVie, I've talked about before, their rheumatoid arthritis drug went off patent and they had to make up for that. These companies basically have a decade to contemplate generic competition. Now, that doesn't mean there isn't competition from other drugs companies, but generics specifically do not appear to be a major threat. And even then, UBS in this Barron's article noted that generic ecosystem will probably only be able to support about 25% of the demand by 2030, even if generics are able to come out. So you get kind of the picture, but I think, again, when you're kind of weighing all this, the biggest potential tailwind is the fact that as we get more research over the next few years, I was just reading in the Eli Lilly's report this week, one of their new drugs in development has alcohol abuse management potential. Okay, that's something that was not on anybody's radar a few years ago. So I think that's probably the biggest thing, is the fact that the market is expanding. So what are the negatives to consider? Well, I think the biggest thing is valuation. Eli Lilly is trading, over 34 times forward earnings, right, which is a big time premium to the S&P. More than twice the valuation of their closest competitor, Novo Nordisk. So you have to ask yourself as an investor, how much of this is already priced into the shares at this type of valuation. I think that's the biggest risk. And of course, the other big risk is just competition. Who knows what kind of technology is going to come out over the course of the next few years that might be a better mousetrap than what Lilly or Novo, have on the shelves at this point or in development at this point. So I guess the third risk factor would just be government policy, right? You never know what the politicians are going to do with Medicare or drug prices. There's been a lot of rhetoric of that coming out of the Trump administration. There'll be a lot of rhetoric coming out of the next presidential administration. So keep all those things in mind. But I just wanted to kind of step back from the stock price and maybe talk about some of the longer-term narratives that I think are going to be important to not only the whole space, but Eli Lilly specifically. A couple others I just wanted to mention briefly. Of course, Apple. We all know Apple. The story on Apple is really interesting, and I talked about this at length on a couple podcasts earlier in the year, so I'm not going to get too much into it. But they've been kind of the anti-AI, really, in the sense that they haven't spent the money that the other people have spent. So, for example, over the past 12 months, Apple has generated roughly $130 billion in free cash flow. To compare it to someone like Oracle, who have burned about $24 billion in cash flow. Okay? I don't think it's an accident that as of a couple days ago, Apple was up 13% for the year. Oracle was down 26% for the year. And there are probably other factors as well. But the market is clearly rewarding fiscal discipline in a way that they were not rewarding it a year ago. Apple was a laggard a year ago when all the other hyperscalers were spending a lot of money. This year, they've been an outperformer for the most part. So it's a very interesting change in narrative. We'll see where it goes. This isn't to say that Apple isn't taking AI seriously. They just upgraded their Siri capabilities, for example, but they've taken more of a wait-and-see attitude, see how it all plays out, which seems to be responded to pretty well by Wall Street. So the issue with Apple, when you look at their most recent earnings, is very interesting. Doesn't appear to be a demand issue. If you look at their most recent quarterly numbers, iPhone sales up 22% year over year. The Mac sales 29% year over year. This is from the Raymond James report. China specifically is outperforming. China revenue up 22% year over year. Remember a couple years ago, people were worried about Apple being able to do business with China. Those fears, at least for now, seem to be completely dispelled. Their China revenue has been very strong. And their service business, remember, their App Store, or I should say the music library, all the Apple Pay, all the services that we pay for, that business appears to be doing extremely well. And according to Raymond James, they now have over 1.5 billion, with a B, paid subscriptions. So even if no one buys phones, that business is still growing because people are still paying for subscriptions on their existing phone. But the negative from the quarter, and the stock has traded down since they released, is they can't get enough supplies. There's a lot of capacity constraints in sort of the nuts and bolts that they need to buy, to build phones and laptops and everything else, primarily in the chip business. So not only do they have to pay more for chips, okay, they can't even find enough chips that they need to satisfy their demand. So the good news is people want Apple products. The bad news is that the margins in the short term are going to take a hit for that reason. So if you look at their numbers, they actually guided down their sales growth. For example, iPhone growth from mid-teens to 10 to 11%. But again, it's almost entirely to do with capacity constraints, not because people are balking at their new products. So how do you kind of weigh all those things? Well, I'll leave that up to you. It's not at a cheap valuation. Apple's trading over 33 times forward earnings, but it does look like there is a lot of demand out there. So there's going to be some back and forth on that. I think probably how this turns out, it's a question of duration. How long do they deal with these bottlenecks in supply? Is this a 2 or 3 or 4 quarter issue, or is it a 2 or 3 year issue? That's going to be the difference between the stock doing well or not doing well over the coming 12 months. So just keep that kind of balanced outlook in mind. But again, the stock overall has been doing better than most of the other large cap tech names in recent months and quarters. Last one I just wanted to mention real quickly is Amazon. Amazon is another name, kind of like Apple, that had been a laggard, hadn't done much over the course of the last year and a half. As of this week, it's had a huge recovery after their earnings and is up, like 18% for the year, something like that. So Amazon has rebounded. Well, why is that the case? Well, the biggest thing is their Amazon Web Services, and I've talked about this before. AWS. It had been a closely watched story, not only in terms of revenue growth deceleration at one point, but also the margin profile of AWS. Well, not only did they come out with the fastest revenue growth in over 4 years, came out with their highest margins ever in AWS. So I was reading something from the Evercore analyst. Evercore believes this, quote, demonstrates very clear positive return on investment on AI. So when you hear rhetoric about what's the return on investment in AI going to be, well, Amazon's already starting to experience that. So that was the major story. There's other things I could mention to you, but if you look at the two big narratives overall in technology, AI and robotics, Amazon appears to be really well positioned to take advantage of both. So I think if you're looking at risk factors there, it's the same risk factor, I would say, with Google or Microsoft or any of these names. How long can these companies keep up this type of capital intensity, building out this AI infrastructure and AI capability? When does it decelerate? Because it will at some point. And is Wall Street kind of positioned for that? Are investors positioned for that? Because one of these days, these companies are going to come out and say, hey, listen, we're going to start to slowly spend less than, or violently spend less than what we did, last quarter or last year. I think that's probably the biggest risk factor here. Valuation for Amazon is not excessive. It's not as high as, Apple or some of the other big names, but it's more the overall AI narrative more so than individual company threats to Amazon. So keep that in mind. But I do think if you are a fan of Amazon, you should be encouraged by the much better revenue growth and margin profile for AWS. That was a welcome development. But keep those risk factors in mind. And as I said at the top, if you're an individual investor and you're considering these three names that I mentioned, make sure you do your own homework or consult your financial advisor. I'll leave it there. Next time, I'll probably have some more updates because I have 5 or 6 reports here that I didn't have time for. Until then, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.